Welcome back to the Bull Moose Podcast, the number one dental niche accounting podcast out there as far as we know. Today, we're going to be talking about financial statements. In the past couple of episodes, we've talked a lot about the building blocks of a practice, from buying a practice, setting up your bookkeeping systems, and all those things. And now you're running the practice and it comes down to your financial statements. How do you analyze them? How do they get structured? And it's a pleasure to be joined by my partners Andrew Witt and Ryan Walsh, along with producer engineer Thomas Still. And as we get into financial statements, I think one of the things we favor here at Bull Moose is a relatively, for lack of a better term, a simplified financial statement or income statement. Andrew, can you talk a little bit about why we want something that's easy to understand versus just here's income and here's a million different expenses and we get to the bottom line?
Yeah, we like to keep financial statements that are simple and consistent. We do that by numbering the categories. So, for example, we'll have income in the 400s, variable expenses in the 500s. Staff costs will also be in the 500s, and then G&A, general and admin, will be in the 600s. We'll also have occupancy expenses in the 600s as well. And then below that, in the 800s, we'll have discretionary expenses along with doctor costs, doctor wages, retirement contributions for the doctor, etc. I mean, we keep it simple because we don't like to see expenses all over the place. Simplicity allows us to follow the statement pretty easy, and clients can read the statements easy as well. Keep it simple and not complicated. So yeah.
But I mean, when you say something like that, where if things are grouped logically, does that make that easier to benchmark a practice in terms of if they're looking at their cost structure? You know, if they don't have to add up 10 different numbers to get to a category, that's got to make it easier for them to be able to benchmark.
Yeah, and I mean, the way we have our financials, it transfers over nice to our spreadsheets that we create that have the KPIs and the benchmarks to send over to you. And it also helps us consistently see the prior year to current year metrics. So you will be able to see if your percentages are going up, going down, what you need to improve on year over year, etc.
So when we look at this, I mean, Ryan, the first categories we have broken out are variable expenses. And if you could probably just give us an accounting 101, what's really the difference between a variable expense and some of these other expenses that are in an income statement?
Yeah, so the variable expenses are kind of, they tend to go up or down with the rise and fall of revenue, right? So as your production goes up, your variable expenses will go up, and vice versa. So, whereas your general and admin expenses, your G&A expenses tend to stay much more fixed. And it doesn't necessarily change as frequently with the rise and fall of the revenue.
In terms of variable expenses, I mean, what are we putting in that particular category as you look at a dental practice? What are some costs that we put in there?
So typically we have clinical supplies, lab fees, and merchant fees. We consider staff costs as variable costs as well. However, we keep those more separate.
And then if you're looking at a client, one of the things they always want to do is benchmark themselves against what they're seeing other dentists doing. When you look at supplies and lab, what should they be targeting in terms of a percentage?
So supplies and labs together, we like to see them at about 12%.
And I mean, when we see doctors going over that amount, my opinion in looking at it, it could be caused by a couple different things.
Mm-hmm.
I mean, the first one could be you're just not very good at ordering supplies. You don't have a monthly budget. You don't look at the inventory that you have on hand. You have enough gauze to get you through the next 50 years of a dental practice, but you keep ordering more gauze every time.
Mm-hmm.
I think you always have to look at, if you have somebody ordering the supplies, maybe giving them a budget on things. one justifiable reason though, sometimes you will see supplies that are high. We generally see that in practices that are growing at a relatively quick rate because more of the production in a practice that's growing rapidly tends to be on that doctor level versus hygiene, where hygiene's coming in to backfill some of that stuff. Or you even have a particular practice where it's very heavy on the dental side. I think we talked in some of the valuation practices where 70-30 is a really good split to have between doctor and hygiene. Well, if you're 85 doctor, 50% hygiene, you might be doing more implants, you might be doing more light ortho or things like that. But if those combined numbers, and the reason we combine them is there is some bleed between those two accounts where, if you have a CIRAC machine or a crown milling machine, where are those blocks being counted in your dental supplies, or are they in lab? If you're doing implant and you're doing Nobel Biocare on some stuff, which category is that ending up in? So if you are above that 12%, we should be looking at the reason why. Sometimes it's justifiable, sometimes it's not. Ryan, talk a little bit about merchant fees. I mean, that's an area where it used to be a really small expense, but why has that become a point of contention these days?
Yeah, because I mean, mostly just because more people are using credit cards these days, right? So yeah, like you mentioned, I mean, it used to be kind of a small fractional expense that was just kind of a, overall just kind of a nuisance expense that people kind of just, considered cost, the cost of doing business. But that's been going up recently. I think that we're kind of seeing it more about 1.5% to 2% of revenue these days, which, our average practice is billing about $1 million a year, which, now their merchant fees are about fifteen to $20,000 a year, and it's becoming increasingly, more than just a cost of doing business.
Now, I mean, one of the good ideas you had, Ryan, is you've had clients starting to charge that back.
Yep.
How has that gone for clients? I mean, are they getting a lot of pushback? I mean, what are you seeing on that front?
I mean, from my client's perspective, it's been received pretty well. There hasn't been a lot of pushback from it. You know, like we kind of do here at Bull Moose, we do the same thing, right? So like, if you're willing to pay ACH, there's no fee, and if you want to use a credit card, that's fine. But we charge back the 2.9% or whatever the fee is back to the client, and I think for the most part, people are accepting that.
Yeah, I think, I mean, here's one for the old heads out there. There used to be a record company called the Exclusive Company in
Mhm.
Wisconsin. I think back 30 years ago, they used to you'd get a cash discount if you paid with cash versus a credit card. And it was really unique at that point. And now I think you go to almost any service provider for sure, and you're seeing that option being offered to, do you want to pay with check? Do you want to pay ACH? But if you do want to do the credit card, it's going to cost you a little bit extra.
Yeah, actually, I've noticed that restaurants are doing it these days too.
Yeah.
Right. And in terms of, I mean, we've talked about, I mean, staff wages certainly is something we evaluate based on a percentage of revenue. But Andrew, what's in staff costs? What percentage should people be looking at? I guess, why are we looking at as its own separate category?
Yeah, staff costs are going to be one of the larger expenses, probably the largest expenses for dental practices. And within staff costs are the wages you pay the staff, the payroll taxes paid on behalf of those wages, the employer match retirement contributions for your staff, any health insurance premiums that are paid on behalf of the staff you can also put in there. And then if you reimburse your staff for uniforms or whatnot, that's also a staff cost. And we'll typically, on the high side, see staff costs at around 30 to 33%. It'll be different regarding rural or urban areas, and then whether you're on the West Coast, Midwest, or East Coast. So you have to pay attention to that as well.
Well, I think one of the biggest changes we've seen, I think coming out of the COVID era, if you will, is traditionally staff costs were kind of a 24 to 25%, and maybe even lower in a dental practice. But I mean, certainly, I think they've been hit by wage inflation. I mean, we see the average client if you take the whole mix of everybody, around 28%. And it, I think it's a combination of just the standard wages have gone up considerably, especially in hygiene. But then if you're a heavy PPO practice, your insurance reimbursements haven't gone up. But when we see clients that are high on that particular expense, I mean, are there any other reasons that they would be high in that particular area other than location or things like that?
If you have too many employees, essentially, too many heads in the practice working for you, that could be why it's high. If you have a couple slow months and your collections are down, obviously your staff costs won't necessarily go down with it. It can be somewhat variable, but your staff's still going to be there working. And I think staff costs are, I don't want to say impossible, but it's one of the things that are really hard to fix. I mean, I think it's important to track just so you can stay in the range of where you should be. But I also think it's important too, and we do a lot of podcasts on valuations, on why you want to make sure the percentage of staff costs are accurate, because you're going to be taking over a practice where if your wages are already high, you have to prepare for that. So I mean, I don't necessarily think it's impossible to fix, but it is one of the harder expense categories to correct.
Yeah, I mean, you're dealing with a free marketplace out there that if hygienists are making on average X amount of dollars, it's not like you can wave a wand and go, okay, I'm only going to pay them $40 an hour. I think you have to look at either increasing production, but I mean, if you do have too big of a head count, and we'll get into this in future podcast episodes of what metrics should you be looking at outside the financial statement, looking at revenue per full-time equivalent and stuff like that, and you may be overstaffed. You may want to make a decision that if you're heavily in a PPO, maybe be coming out of network with that so you can increase top line. But even from our own experience, I don't think the wage aspect is going down. I think we can look at our own business and say, what was the cost of bookkeepers pre-COVID versus what is the cost of a bookkeeper now, and it's radically different.
Yeah, and I mean, it's hard, from what we've seen, it's hard to hire good staff. So even if the percentage is high, it might be even more expensive to try to lower the rate you're paying and to hire someone else.
Oh,
So
I think that's
tough.
absolutely accurate. Yeah, staff costs has become, I think, the biggest issue in most of our practices. So then we move to general administrative expenses. Ryan, kind of give us a little overview of general and administrative expense. More of a fixed cost, more of a variable cost? What's in that particular category?
So those costs are generally considered more fixed. They are, we like to see the G&A expenses at about 6 to 8% of total revenue. They consist of things like advertising, bank charges and fees, consulting, legal and professional, technology, computer expenses, things like that.
Where are some of the areas, I mean, when you see a client overspending in that particular area, where are the areas? I mean, like liability insurance is going to be liability insurance for most of our
Right.
clients. When they pay dues to, their state association, it's usually pretty fixed.
Yep.
When you
dues,
see
yep.
overspends, where are you seeing that?
As of recently, I've been seeing a lot of consulting fees. Those have been going up, and I've seen a lot of computer software fees going up. That's been on the rise the last couple of years, especially since COVID. Just seems like all there's new softwares that people are signing up for, but even the existing softwares seem to be going up in price as well. And advertising as well. I think that's another category that you want to keep an eye on, just to make sure that it's not creeping up too much.
Yeah, and I think if you look at benchmarks just for those individual expense categories, if you are spending more than, I would say, 1.5% of your revenue on advertising, there should be a strategic reason behind it.
Mm-hmm.
Maybe you're making a big investment for growth. Same thing with a consultant. I mean, we usually look at professional fees in most practices, which consulting falls under. That should be 1 to 1.5% usually of revenue.
Mhm.
Again, it could be an investment in, the growth of the practice, but I was just working with a client where the practice has been going almost in reverse since the consultant arrived, and that's not to bang on all consultants, but when you hire somebody into that role, there should be a specific goal within it. And I think what I would say on like the computer and internet is, I mean, we deal with this in Bull Moose, everything's become software as a service. In terms of your tech stack, make sure there's no duplication of things that could be done with one software instead of two. And also, if you are using, there's dental IQ and some of those metric things that you can buy for practices that are relatively expensive, make sure you're actually using those, and the statistics that those produce are actually helping your practice. Or else you're also going to have a computer and internet expense that's 2.5% of revenue, and it's not doing you much good. Where again, back in the old days, that expense used to be 1/2 of 1%.
Yeah.
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 And I think advertising is a very fascinating number to watch on a month-to-month basis. Because obviously, as a startup, your percentage advertising is going to be higher. Mature practices likely be lower. But sometimes you have the middle ground where you're trying to grow, like you said, and that number gets higher, which in hindsight you should see your collections increase, so the percentage should stay level. So I think it's important you track the collections when you're spending on advertising, and you're also tracking your new patients each month to make sure it's actually paying off.
Yeah, and I would tell any client there's going to be a lag in those two numbers. You put that heavy in, advertising investment out there, but 3 months from now, is that translating into revenue increases above and beyond a certain amount, that you should have? And if it's not, okay, does this advertising need to be spent better? And I think you're also right. I mean, mature practices, I think once you have enough patients, you're always going to have enough patients. If you're doing a good job, you're going to get enough referral and stuff like that. And I would just also argue, if you have a standalone location, that's probably the best advertising you can do,
Oh, yeah.
in terms of being a dentist. So we do the G&A costs. We're talking about 6 to 8% should be being spent there. Next big cost item up there is going to be occupancy expense. Andrew, I mean, what falls under occupancy expense, and what are we looking at for the percentage there?
Occupancy is going to include the rent, repairs, maintenance, real estate taxes, property taxes, personal property taxes. You can also include like any janitorial or cleaning, but sometimes that'll just get added to like repairs and maintenance. But occupancy, you're looking at 5 to 8% from what I'm seeing. And I think that number, it depends if you're renting to yourself, because that number may be higher for the tax advantages there. But yeah, I think 5 to 8% in occupancy is pretty standard.
Yeah, and I would say anytime we see it high, more often than not, it tends to be owner occupied. But I mean, we've talked about it in the valuation episodes too. Occupancy is a really hard expense to undo. So if you have a physical space that's way too big for your practice, or you're in a metropolitan area where rent is just higher, well, we can't go ahead and change that. We can only produce our way out of that and getting it to the right percentage. So again, I mean, if you are, at 10%, it could make sense if you're building up the practice, you're new to it, you just moved into a new space. But again, the goal there is to be probably somewhere between that 5 to 8% overall on the numbers. So I think that brings us into, we look at structuring the financial statement. Our client is given a statement that includes these particular groupings and accounts under it. If they take their income minus these expenses, we get to a thing called operating income. And to me, operating income is really important, because if I take that number from 100%, that tells me what my overhead of the practice is. So on our financial statements, you should be able to look very quickly and be able to see, well, what is my overhead? And if you're a general dentist, the ideal goal is to be at about a 55% overhead in a practice. And that's going to be a combination of your staff costs, your variable costs, general administrative, and occupancy. If your overhead's 55% or less, you're in really good shape. If it's over 55%, there's probably some things that could be worked on. I would say our average client coming out of COVID is right around 57 to 58%. The big driver of that is staff costs going from a norm of 25% to 28, all the way up to 33% for many of them.
Mm-hmm.
To finalize the financial statement, there's things that we put below the line. Ryan, can you talk a little bit about why we put some items below this net operating income line, and what expenses are down there before we get to a net income?
Yeah, so we like to refer to some of these expenses as just as more discretionary, right? So like the things that go below the net operating income would be officer compensation, like the wages paid to the doctor, retirement contributions made on behalf of the doctor, anything related to the doctor's compensation, maybe, and then interest, depreciation, amortization, things like that. So, and we do that for a reason, so that we can typically pull out what the overhead is easily, very quickly by looking at the profit and loss. Because we like to see how the practice performs without those discretionary expenses.
Well, and I think if you look at, doctor compensation, for example, some practices have associates, some practices don't. Some practices, depending on how they're incorporated, if they're an S corporation, there's an incentive to maybe pay that dentist less than fair market value wage. If they're a C corporation, there's an incentive to pay more than fair market. Or they could be a Schedule C where they're not taking a wage at all.
Mm-hmm.
And you look at expenses like depreciation. Some years you might have a lot of depreciation, other years you have zero. So I really think that net operating income number we have is kind of our apples to apples comparison of dental practices. Those are the controllables within a dental practice that when we look at overhead and a pure apples to apples, we can have a very good fix as to, is this a well-run practice, is it not?
Exactly.
So to recap, this conversation, we look at the financial statement, and you can reach out to us. We'll give you a sample of what our financial statement looks like. But again, you're going to be looking at, as you're trying to benchmark your particular practice, we're shooting for about 12% between supply and lab. We want to see about 1.5% for merchant fees, but we want to see that particular expense start to go down as more and more clients charge it back. Staff costs, the reality is you're probably going to be somewhere between 28 and 30% in a lot of practices. If you are way above that, start taking a look at potential reasons for it. It could be your head count. It could be maybe your wages are just way out of line for what somebody should be. You should be looking at, are you heavy PPO? Are you fee for service? We look at general and administrative expense. We should be looking at 6 to 8% on those numbers. And then occupancy expense, kind of a 5 to 8%, shooting for a net operating income of 45% at the end of the day. So take a look at your numbers through that particular context. If your numbers are way above that, as always, feel free to give us a call. We can kind of look at some root causes. I do think when people talk about using dental CPAs versus a generic CPA, if we do have clients who are over in these categories, it's something we're tracking, it's something we're taking a look at and trying to look at, is there a cause that can be fixed on it?
Mm-hmm.
So it's very important to kind of look at the financial statement. I think in wrapping this up, again, we talked about it a little bit in prior episodes, but on a month-to-month basis, I wouldn't worry too much about it, but you start seeing things out of whack on a quarterly basis. that's probably a cause for concern, a cause for review, and to take a deeper look at it. And wrapping this one up, our next episode, we're going to talk a little bit about some of the metrics you should be looking at outside of the financial statement that will indicate the health. But as always, pleasure to be joined by my partners Andrew Witt, Ryan Walsh, and producer engineer Thomas Stilt. Again, subscribe, like, write us a review, get us some questions for the mailbag. And until next time, the Bull Moose Podcast signing off.